Good morning, sir. First of all, thank you for joining us here on First Thing, and a very happy New Year to you. But the markets have not had the best of the starts to the new year. Nifty is down about 1%. Bank Nifty has given up about 900 points or so. What's weighing on the markets?
Yeah, I would say that, see, what we are witnessing in the markets is a healthy correction because the sharp rally that we have witnessed, and also as you were rightly said that we've seen some sell-off happening in the global markets as well. So global cues also to a certain extent they have been, I would say, muted past a couple of days, but our markets have been resilient and they've been holding high. And also, if you look at the advanced decline ratio, that also is as of of today, right now, it's more than three advances versus one decline. So that shows that the broader breadth of the market is there. And also, we are seeing across industries, with the pharma space, with the FMCG, the auto, be it the metals, be it the bank space. So across the board, we are seeing, and across not only large caps, mid caps, small caps, there also we are seeing a sizable up move. And the best part is that, as you rightly said, we are seeing a cool off in the India VIX, because earlier India VIX traded above the 16 level, so trading above 16, 18. 16 is fine, but above 18, 20 is definitely a cause of concern. So it's back below the 14, 15 levels. So that clearly shows that investors aren't really unduly much worried about anything. And also, I would say crude oil prices continue to remain. Look at Brent crude trading below $80, sustaining at that levels. Earlier, there were some, I would say, concerns, and those concerns are still there with regard to the route change for the oil shipping companies. So those things are there. But despite all that, the market, excuse me, Indian markets have held firm. And if I look at the levels, if you ask me what the levels for Nifty, Nifty somewhere on the downside, 21,500, that's a zone of support. 450, 500, that's an immediate zone of support. On the upside, 21,800 is a level to watch out for. So it's a more of a trading range. However, if I look at technically on the charts, technically on the short-term charts, there is some sort of fatigue, or I would say profit booking, or some sort of consolidation that is definitely visible on the short-term charts. The long-term charts, however, remain extremely strong and positive.
All right, so you'd call it a healthy correction, Amar, wouldn't you?
Yeah, I would say that in any bull market, this is a positive thing, and corrections basically because you've got all sorts of market participants who are invested in the market, also those who are waiting on the sidelines. So for them, the risk reward ratio also matters a lot, depending upon their holding period, depending upon their risk appetite. So a healthy correction gives an opportunity for more fresh money to enter into the markets, and also it gives a higher level of risk-reward ratio as well. So I think that's definitely a good sign in any bull market.
All right. The US Fed meeting minutes for the December policy minutes were also released overnight. They essentially indicated that, while there will be rate cuts of at least 3/4 of a percentage points this year, there is still uncertainty about when. So, do you think, the kind of rally that we saw late December, at least in the last 2 weeks, we were too aggressive in factoring in those rate cuts?
The markets are what they are, and they'll always remain that way. So they have their own mechanism, their own method of actually factoring in major events. And they also, the best part is that markets also keep on calibrating. So it's not only that they factor in and they stay at a point of time. So it's always the important news flows, because news flows are plenty, but markets majorly look at the major factors, be it the US related to the US Fed Reserve, or the European Central Bank, or the major economies, including China. So GDP figures, inflation figures, these are the major things that, and apart from that, yeah, crude oil definitely, and the dollar index. So these are few things which the markets definitely consume and calibrate at the same time. Having said that, I would say that markets are expecting, and they definitely should be rate cuts in the US, because inflation has also come up from 8% to almost 3%. So US Fed would also be under pressure to cut rates. The only question is it going to happen in the first quarter, second quarter, or in the second half of the year? So most likely, it doesn't seem that it will happen anywhere in the first quarter, or maybe towards the fag end of the second quarter is what investors are expecting. So we'll have to watch out for how that plays out, and also the sequence and the sequence of rate cuts, whether it's going to be one and then consecutive rate cuts, or maybe there could be a pause. So these are certain things, and these would, I would say, to a great extent, will be determined how energy prices play out over the next quarter.
All right. And Amar, one particular sector that is not doing well, at least in 2024, and we'll just come to you in a bit. But Amit, talk to us about the IT pack. That has declined by about 3.5%, and that is after giving returns, phenomenal returns in November and December. So, what's weighing on these IT stocks?
If I look at the top four stocks in the IT, the TCS, Wipro, HCL, and Infosys. Infosys has given returns over the last 1 year of barely 0.09%. HCL, probably because of a lower market price of only 22.18 right now, has given 34% returns over the last 1 year. Wipro also, just 456 rupees market price, has given returns of around 17%. But Infosys and TCS barely above 10%. But one of the reasons, even if you look at the headcounts in all these companies, Infosys recorded a reduction in headcount of 16,454 in the second quarter of the financial year 2024. Wipro reported a drop of 14,472. Tech Mahindra lost 13,308 employees. TCS saw the headcount go down by 7,186. So the headcounts have been going down. That could be one of the reasons. But if I can broaden the purview of our research to the tech sector, not just IT, gaming has done very well. So I'll just give you some numbers. 15.4 billion, that was the number of games downloaded in India this year, despite the rise in GST, and this was second only to China. The number of GCCs that have come up in India is 1,600. These are global capability centers that are offshore units of multinational corporations, and this is likely to this has come from prominent names like MetLife, Warner Brothers, Fidelity, and BlackBerry. So this is likely to increase the employment in India by 1.8 lakhs in the coming year. So if we tech sector has not done well, IT, but tech broadly has done slightly better.
And Amar, I'll come to you here. Do you think it's a consequence, a kind of correction that we have seen in the first 3-4 sessions of 2024 in the IT pack, a direct consequence of this uncertainty regarding the rate cuts in the US?
I would say, looking at the IT pack, if I look at the Nifty IT index, so that witnessed a significant rally from almost 30,000, I would say that was in the first week of November, to a high of 36,000. So that was a significant, almost a 20% rally. Now it's around 34,300 odd levels. So you rightly said, see, what happens is that whenever there is a major move, there is an opportunity for investors to book profits, be it, and the large caps, look at the names of TCS, Infosys, they also witnessed a significant rally across the board for other IT stocks as well. Having said that, I would say IT still looks positive on the charts. The IT index looks positive on the charts. So this is again a healthy correction. There could be some further correction to the indices. If I look at the major IT stocks, like for example, TCS, again, TCS is approaching a very crucial support zone. So somewhere around 3,600 levels is going to find support, and we could expect a bounce back. So what is likely to happen in the IT space is that most of the IT stocks could go in for some consolidation. We're not expecting some major correction, but it could be in for some consolidation, which we could witness over the next couple of weeks till we see some further clarity coming from the US.
Good morning, Mr. Singh. I'm talking about Infosys. This has given the least amount of returns in the last 1 year in the entire IT pack. Is there anything we are missing, or is it a good time to get into this stock right now then?
See, if you ask me, Infosys really doesn't inspire much confidence looking at the long-term charts as well, because short-term, we've seen the stock pull back from 1,400 levels to almost 1600 levels, currently it's around 1500 levels. But if I look at the long-term trend, so the momentum is missing from a long-term perspective. So if you ask me about IT stocks, at least specific to Infosys, I would say that it really doesn't inspire too much of confidence from a long-term perspective until unless we see a trend change and the stock sustaining above its recent highs. So that's going to be very important. If I look at TCS, TCS is slightly better on the long-term charts as compared to on a comparative analysis vis-a-vis Infosys. So Infosys would need to trade above 1600 levels consistently for a trend change, and TCS would need to consistently sustain above the 3800 level for a significant trend change. Otherwise, we could witness consolidation in these counters.
All right, that's the view coming in from Aamar Deo Singh. Sir, always a pleasure speaking to you. Thank you for joining us here on News 9.
Thank you for having me on the show.